Hello, Edwin. How are you doing? It's been a while. I've been traveling a little bit, so we couldn't catch up. But I'm eager to chat with you today.
Yeah, hi Magic. Good to see you again. It's too long ago, I think.
Too long ago. I've been to a number of places. Okay, I did go to Chicago for the B2SMB conference, which was a really interesting event. And maybe next time that we do it in May, I need to pull you in because your experience with the channel and our recent discussions might be a great contribution to the members, to the discussions that members of the B2 SMB Institute have during those events.
Would be great.
A lot of discussions were on the artificial intelligence and the productivity improvements, and I will be posting some more videos and interviews from this event soon. So I hope that you will get the gist of how the discussion went. Then I went to Houston. I've been in Houston for a weekend.
That's
Did catch
good.
up with a lot of friends from HP and HPE, but I also had a chance to visit uh, uh, the University of Houston because we are starting a project with the University of Houston and the B2SMB Institute, and there's going to be a lot of interesting stuff going on. And finally, I had been to Seattle for the Lenovo Tech World.
So you traveled a lot. It's funny because you traveled a lot. I didn't travel at all, but I recorded a couple of more podcasts that will go live in the next 2 months until Christmas. So I'm actually now done with all the recording for this year, and then there will be a few interesting one coming up regarding also investments.
Investments. That's an interesting topic, Edwin, because I think that a lot of people kind of when you are in a corporate environment, you get your bonuses and your stock options and what name you. And I myself, for many years, I participated in any employee stock purchase programs, and I got a lot of stock options. Obviously, being an executive at the company. Um, but I never thought about doing anything in particular about it. I just kept the stock, to be honest, and I was probably one of the more conservative or not investment savvy ones. You've done something else. You actually proactively invested money.
Yeah, you explain it very interesting, very interesting way. Now, yeah, I started actually. Um, no, let two steps. I started with stocks. I think 30 years ago. I put every month 50 euros into a fund. And what you said, when you are working for HP, you get stock options and all kind of stock possibilities, and that will they will uh, ex, um, execute in 1 year or 2 year or 3 years. Um, but during that time, being honest, I had no time at all to study or spend time on how to invest. And being honest, we don't learn it at school. You learn at school economics, but you don't learn how money works, how the stock market works, how investment works, how money works. So when I stopped, I get involved in a lot kind of personal development courses, trainings, online courses, and also in investing. And a lot of people say that in stocks or investing, or we can discuss the different topics, is risky. And I say that's also what was my feeling in the beginning. There is a risk, but there's also an upside. And if you put your money on the bank, it's also a risk because inflation is there every year. And we know for the last 5 years, I think the inflation all over the world is enormous, between 5 and 15%. So your money um, devaluates every year 15% or 10%. So you can buy less with the same amount of money, or every product becomes more expensive. So that's a negative investment. Your money becomes 10% less every year without doing anything. So that's the reason why I figured out I have to invest to do something to let money work.
But Edwin, honestly saying, I've heard the stories many times. Like, hey, don't keep your money in the bank, because the inflation is gonna eat that. It is true, but you can do a very simple thing and just put your money on the kind of on the account that gives you a little bit of a percentage. So you can slow down this kind of a depreciation of the
Yeah.
funds that you have, and then can obviously diversify. One of the reasons I kept HPE stock for a long time was everything was kept in US in dollars,
Mhm.
and as the Polish economy was a developing economy, and for many years, the currency cost would appreciate rather than depreciate.
Mhm.
When I was kind of calculating my net worth on a regular basis, even though sometimes the stock would go down, my value in zlotys would still
Yeah.
go up because the dollar would appreciate. Okay, and what I've seen is from every year there was an appreciation. Okay, the combination of stock from HPE, the holdings that I had in a bank, there was a small percentage,
Yeah.
increase. Was it higher than the inflation? Well, inflation was not that high maybe a couple of years ago. What happened during COVID and over the last 2 3 years, obviously, like after the war in Ukraine started, the inflation skyrocketed. But other than that, I cannot say that I was very uncomfortable with my strategy. There was no upside, but there was practically no risk either.
Yeah. I can imagine. I mean, I think what you did. I mean, this is not financial advice, by the way, what we discussed today. Um, but just what we did and what we experienced ourselves. But what you did, you put something in stocks and you put it in a different currency. So that's already different diversification of your risk, spread the risk. So not only in Poland, but in different stocks and in different currencies. And if the dollar goes the other way around, maybe you can lose money, but at least you do something.
That is
And
very true. So I think what we can agree on, Edwin, and I think for all those guys who are and and we're gonna skip to like move to the discussion what happens when you are not in a corporation anymore. But I think when you're working for the large corporation, go and check because most of those corporations have an employee stock purchasing program. Okay, so you can put additional dollars a part of your salary into stock, into the company stock, and you can judge. I mean, because you work for the company, you really have a lot of and access to a lot of information. Okay, about its kind of a long-term condition. I don't think that uh, the rules will for sure prevent you from taking advantage of a short-term moves. Okay,
correct.
so because that would be insider trading, and no company will allow you to do the insider trading. So you are restricted when you can sell and purchase or execute your stock. There are restrictions, big restrictions on that. But from the long-term perspective, if you believe that the company that you're working for has a long-term good prospect, put as much money as you can into the stock of your own organization. I think that's the advice that we can agree on, Edwin, right?
For sure. And I think also, if you are still young and you get promoted, and I did exactly the same, you get promoted, you get a bigger salary, very often a bigger company car, so it costs you more money, by the way. You decided to go more often out for dinner. You buy more expensive clothes. You buy maybe a bigger house, uh, two times holiday instead of one. So, I mean, we are used to, and also maybe influenced by the fact that if you earn more, you have to spend more. You're gonna spend more. Um, and if I'm looking back, and we're gonna discuss what I did after I stopped, but looking back, I earn more and more and more money. But actually did exactly what I just said: a bigger house, a bigger car, more expensive holidays, more clothes, whatever. So we
Do you
are
think
used.
that was a mistake?
Sorry.
Do you think that was a mistake?
Looking back, I think it was. Is the mistake? I mean, you must have fun and you must enjoy it, but it's short-term gratification. And yes, you have to live today. I agree on that. But if you start investing on an early age, on young age, the impact of the time um, is a very positive, um, has a very positive impact on your annual return. So if you're 25 and you start investing 50 euros or 100 euros or 500 euros, whatever you can invest every month, the impact is enormous. So what I say is, if you start earning more money, use the additional money to invest, and you will see what the impact is on the longer term. And then you can still decide what you're going to do with the return or with the money. Stop working, work less, invest something in a company, start your own company, buy a car or buy a new house, whatever. But or use it for study for your kids. But what to say is, I mean, we are used to work for a company, for a boss. We get paid for the work we do, but we don't learn to invest. Because if you invest, the money works for you instead of that you work for the money. And I think that's the opposite idea.
I think you're right. So I would totally agree with you on one hand, because I do believe that when you look at your monthly salary, what you should do is you should put a portion of it into some kind of saving investments, etc. Okay,
Mhm.
I think it's very smart to put that in some kind of a investment fund, because they typically deliver returns. Although I must say, Edwin, that uh, that's like 20 years ago. Maybe that's why I burned my fingers, because I actually did invest a certain portion of my income into investment funds, and it crashed, and I lost most of it. I mean, I didn't make any money. I just lost, and that was not a great idea. And I would also cautious people, because on the other hand, if you squeeze yourself a little bit too much, I had another friend that was very early in his life, in his career, he decided that he's going to put 50% of whatever he's going to earn into investments. And that was his rule. He said, like, you know what? I want to retire when I'm 40. When I'm 40, I want to completely retire. So I'm gonna put money on the investment. And he really squeezed himself from not spending a lot of money on fun stuff. Okay, uh, well, he couldn't foresee the health challenges that were sudden and unrelated, and then he cannot take advantage of all this savings that he has made and investment that he has made. So I would be very cautious to make sure that when you earn more money, I think you should enjoy this, because it's your hard work. You know, you worked for this so much and so hard, that I would still encourage people to go and take a healthy vacation, whether you enjoy skiing or enjoy lying on the beach, whatever helps you to recover and kind of a recharge your batteries. I always was
I, I,
really
I agree
keen
on
on
that.
that.
Yeah. So I call it creating memories. But what we very often do is that we spend money on things that cost money. So your monthly fixed cost will increase. A bigger house has a bigger
Correct.
mortgage. A bigger
Correct.
car has a higher insurance. Um, so your fixed cost will increase. So you need to keep working and earning the same amount of money to live up to your standard you created. Because what you very often see that people who spend more, no, who earn more, spend more, and that they even in the same golden chain or rat race, because they say, yeah, I can't stop because then I can't afford my life anymore. And then they spend 10,000 euros a month, whatever. The other people think, oh, hold on, why can't you live with 10,000 K? Because they have so much cost that they have to keep working. And what I say is, um, the interesting thing of investing is what you said. If you put all your eggs in one basket, there is a risk that it goes wrong. So some people say that, yeah, that it's good to spread your investments 25, 25, 25, 25. 25 on in property, 25 in stocks, 25 in gold and silver, 25 cash, and then 5% Bitcoin. That's 105% totally, but you know what I mean? Approximately that spread, what these people say. So then you spread the risk and you will keep up with what's happening in the world, whether gold is going up or down, or whether the property market is going up or down, or the stocks are going up or down. And if you do it every month a little bit, there's a rule is called compound interest. So for example, if you put $100, €100 in a fund with a 5% return, it's 105 after 1 year. But if you put in another 100, it's 205 plus 5%. So if you do it every month a little bit, the impact, and there are, I think, formulas on the internet, compound interest, just put in €100 a month and see what the impact is on 5 years' time. It's enormous. So what I say is, if you start investing, the money will come to you, and yet there is a risk, but there's also an upside. And if you invest in the right assets, they keep their value, or actually their value will increase.
What happened when you left? I mean, because that's, while you're working for a large, for the stable job, okay, not necessarily large corporation, but in a stable job, it's relatively easy to kind of sit down and plan for the future, because your income is pretty stable, and then you can basically also make some assumptions on the salary increases, bonuses, and everything. After a while, you get the the understanding what you could expect. What happened when you left?
When I left, I mean, for first I took 1 year off for myself to actually recover. And that's also one of the reasons why I started a podcast, to share with people what I did. I had to recover, and I spent a lot of time on health, on food, on vitamins, on all kind of specialists to help me to get even healthier and better. Start on personal development, and start on building my own company, but also start to learn investing. Being honest, I mean, I didn't spend time during my work life to get educated on investing. So what I did is, I took a 1 year off, then I start my own company. At the same time, I get in contact with people who invest in property. And then I learned, hold on, if I buy a house, I refurb it so it gets up to a new standard, and I rent it out. Of course, you have interest cost or mortgage cost, but if the rent is higher than the cost, you earn money. You help somebody on a new house because they're happy. There is an increase in value of the property itself, because the stock market, the property market goes up every year. The last, I think, 30 years, and you get a kind of, they call it passive income, but it's not, because you have to do something around it. So you get more in than the costs are. So you get a kind of return. And if you stop working, the tenant is still in that house, in the property, and they will still pay their rent. So you still get income. So that's the moment I realized, hold on, I have to use the money for something different. And if you have a mortgage, yes, that's not your own money. But if that money has a bigger return because of the rent they pay than the cost of the mortgage, you let other people's money work for you. So you pay an interest to the bank for example, 5%, and the return from the tenant is 8% or 10%. You earn 5%, and it's not even your own money. So that's the moment I realized, hold on, I have to do something. And that's the reason why I started to invest in property in the UK at that moment.
In the UK, okay. And why not in Netherlands? You would make a fortune if you would invest in the Netherlands, because I think, if I understand correctly, after Brexit, a lot of companies moved over to the Netherlands. A lot of students that used to go from Poland to UK to study, suddenly the cost of study became extremely high. And when I speak to most of my friends, the kids are going to the Netherlands to study.
Yeah.
And one problem they have is they cannot find a place to stay at.
Yeah. Yeah, you're right. I mean, looking back, maybe it was the Netherlands better at that time. Um, but we started in the UK because at that moment there were some regulation already in the Netherlands, and it didn't feel good. So we moved to the UK because one of our coaches was investing in the UK. So we actually followed him, and he teaches everything to us. And there's a shortage of rental houses. There's a huge number of empty old houses that we refurbed. The economy is growing. The population is growing every year. So
Yeah,
the investment, not in London, by the way, but in for example in Wales where we invest, the investment of to buy you can buy a house for 80 or 100,000 euros, where the average house price in the Netherlands is 350 to 400,000 euros. So you can easier invest in one house than in the Netherlands. So it's easier to start over there.
okay, I get it. So investment in properties is one of the recommendations that you make, and the way you invested, you didn't invest directly, but through some kind of an intermediary, or how did you do that?
First, we used companies we called sourcing partners to find the properties we could buy, and you pay a fee for that. Being honest, I didn't always have the right good experience with them because they want to make money out of it, of course. So now I have my own network built up with people who know the environment, know the properties, and so they offer it to me and they help me. So I invest first my own money, and I also borrow money from friends and family to invest in the property, and I pay them interest.
Okay, that's smart. That's smart. Leveraging your knowledge and network,
Yeah,
and then gain the capital to amplify that. That's smart.
yeah.
Maybe we need to talk after the podcast.
Yeah. And I think one thing I want to share because it looks like everything is in property. Um, and if you use other people's money or you have a mortgage, you can grow faster. But there was a time when COVID, I think COVID was 1 year on. I thought, hold on, what's going on in the world? I have no clue. There were some people say it will grow, other people say it will collapse the economies. So I have no idea. So that's the moment we decided to actually spread our investments over gold, silver, stocks, bitcoins, um, and to leverage actually from the diversification of the investment, what you just explained in the beginning of our call. So I can
Smart.
not an advice, but to show people what we did.
No. It's a good idea. Definitely, it's a good advice, good idea, good.
There's
It's
no
good
financial
to.
advice, by the way.
It's not a financial advice, and I understand why you are saying this, because I think we are not financial advisors, so we cannot give a financial advice. We are not trained or certified or anything like that. So it's nobody should treat that as a guidance on how to invest your money, right? It's more of a sharing of experiences.
And I think a disclaimer, no, not a disclaimer. I think if you would like to invest, a big question is what kind of investor do you want to be? Is the passive or an active? Um, if you are very passive, you can easily do it automatically in stocks, for example, or lend money, like I borrow money from people to a certain interest rate. They do nothing. They borrow me money, they get their interest. So for them, it's passive. For me, it's active because investing in property is not a passive income. It's all the stories on the internet that say it is. It is hard work. Building a network, there are problems, there are hiccups. Yes, sometimes you have not a profit or have no profit at all. Additional costs, um, maintenance. So there's always something going on. If you compare the number of hours I spent on property, it's much less than I spent on the work before. So that's also the reason why I would like to say disclaimer is it's not all easy. So if you put it on the bank for 3% interest, it's easy. You do nothing, you get 3%. There is no risk between brackets. Um, only when the bank goes bankrupt, like I think it was in Greece last year or Switzerland last year, a couple of years ago. Um, That's easy. But investing at the end, they will have a bigger return and put it on the bank.
What about the challenge of when you leave a large a corporation, especially in Europe, after many years, you obviously get a package which is typically pretty generous. Okay. Did you invest all your money from the package, or did you use some kind of a formula how much to invest and how much to keep? Because obviously, you don't get a job instantaneously. Many people won't get a job instantaneously, especially right now after there were so many layoffs in the tech industry, right? Did you use any formula to split your package into investment and consumption?
I think I had the luck that I at least was able to save money the years before on just
Yeah.
on a saving account. So we used that in combination with the stocks we already had. We sold some stocks to invest in property. So that's where we actually started. We started to focus first on property. Um, you could do one thing at a time. So do first one investment type and get good at it, or at least ask people to support you. I support also people who are investing in the UK and coach them. So ask people who've done it before and let help you. And if you are familiar with that kind of investment, then do the next one. So I did first property, and then I start um, educating myself in gold and silver, and then I start educating myself in Bitcoin. So that's the advice I could give. So that's the reason why we didn't spread in the beginning. In the beginning, we were full focus on one asset, and that's
So
the reason why.
diversification, your recommendation is diversification.
Yeah,
You use, I mean, again, I think my challenge after leaving the corporations, I didn't want to put my money. I did invest some money in the properties, in the property market, but that was that was an idea before I even left. But then I decided to keep the rest because, frankly saying, it offered me a runway to the next jobs and projects.
yeah,
When you leave the company, there's obviously this kind of a moment when there's no stable salary, and I still don't get a stable salary at the moment. I only make money on the projects and consulting and this kind of stuff. So, well, this kind of a cash that I kept gives me a a buffer, you know, to
yeah. So
bridge to the when all the projects work out and they start delivering dollars.
yeah, I agree. I mean, you must also do what makes you comfortable. And sometimes they say there's a kind of formula or rule, and I don't know whether what's the right one. That you need at least 6 months savings so that you can live for 6 months, all your costs, all your spendings without earning anything. So at least you have a buffer for 6 months. That's what you say. Some people say 12 months, some people say 3 months. So yes, you need some savings. And as long as you don't have investment where you have return or where you can cash flow it, if you have a monthly cash flow, then yeah, it's a balancing act. And I know people who they were younger, had no kids, and what they did, they sold all their stuff. I mean, at least expensive stuff. Their car, they bought a very old, cheap car. They sold expensive furniture. I think they sold their house and started renting, so they had money out of their house, and they start investing in cash flow assets, and then they start building it. So what they did, they reduce their costs, their spending to a very low level, and invest every money they earned. So that's a way where you can grow quickly. But if you
That's
feel
when you
more
don't have kids, Edwin. I think, in my case, that was not an option. With
no,
three with
yeah,
three
neither,
girls,
neither for
teenager
me.
girls. Not that about girls, it's just three teenage kids. You have to. I mean, I cannot sell my house and kind of a significantly stop paying their tuitions for the schools and stuff. So that will stay for the time being.
Yeah.
Good advice. So if I would summarize it, if to all the people that are watching us and our friends, It looks like if you are still in a stable job and a company offers you ways to invest with your company into your own company, provided that you trust in this company. Learn how to invest from the proper investment advisor, not like Edwin and I. We have some good or bad experience, but we have some knowledge, probably not as good as the professional ones. Uh, and always distribute your saving into several different places. Like you mentioned, property, stock, gold and silver, currency. Those are probably the
Bitcoin.
directions.
One
Bitcoin as
last,
well.
yeah. And one last advice for people who want to know how money works. There's one book, I think all the investors know that. It's from Robert Kiyosaki. It's called Rich Dad, Poor Dad. And it's an interesting book comparing two kind of dads with their sons, how they invest and how they spend their money. And I think if you read that book, you got to understand what's happening. And they use a quadrant where you are employed, self-employed, a business owner, or an investor. And they share in a nice story what the difference are and what the end result will be. So I can advise everybody buy that book in your. I think it's available in different languages. Rich Dad Poor Dad from Robert Kiyosaki. It's not an advertisement from my side, but it's a very good book.
Edwin, thank you so much for the chat, for the conversation today. And well, the next time we will speak probably in 2 or 3 weeks, because in 2 weeks I might be in Florida. So then probably the week after.
It's fine. Let's do that. And
Thank you so
hopefully
much.
it's useful for everybody. Hey, thank you.
Thank you. Bye.
Thank you. Bye bye.